Hi, this is lesson 1.2c. We're going to finish off these early corrections of, entries with a couple of more different ones here now. All right, so far we have been dealing with payments of an expense, with purchases on credit and sales on credit. Now, when we do cash transactions, you can have a purchases for cash, you can have a sales for cash. That's immediate settlement. Now, what we have been doing were the ones on credit. Yeah, so you could have purchases on credit, and the purchases on credit were with creditors. Yeah, you bought goods on credit from creditors. If there was credit sales, well, then you sold them to debtors on credit. And that was basically this deferred payment. But you can have cash sales and cash purchases. Now, that introduces you to a different type of transaction, because in this case, the business is both the giver and the receiver in the same transaction. Let me try and give you an example here. So you go into a shop and you buy a can of Coke, right? You're a cash customer. So in other words, say you are the business, you're giving money and you're receiving the goods. And that's all that this is. The business is the giver and the receiver. And that would be with a cash transaction. So you have to know the difference between purchases on credit, sales on credit, and purchases and sales for cash. If it's for cash, there are no debtors or creditors involved in the dealing whatsoever. Now, so if we take the first one, sales, I'll do this over here. So you take your sales account. Yeah. Sales is always credit. Why? Because the business is giving goods. The goods are going out of the business. So you're going to credit sales. If there was an amount of money there, it doesn't make any difference what it is. So if you were selling on credit, you'd be selling to debtors, but you're not selling to debtors. You're selling for cash or bank. Yeah, cash. Bank, same thing. Cash, bank, no difference. So you are, in other words, you are the business. The business is receiving money and giving goods. And that's what that transaction is up there. And this transaction here, purchases. And again, always remember, purchases are going to be debited. Yeah, purchases account, I'll just abbreviate it PORS. So you're going to debit purchases. Why? Because the business is receiving goods. They're buying goods, but they're paying for them immediately. Credit the bank, stroke cash, because the business is giving money and it's receiving goods. In this case, the business is giving goods and receiving money. So in that case here, in these cases here, they're both the giver and the receiver. All right, slightly different transactions. So if I can just leave you with these couple here, and I'll come back to you and I'll show you the solutions to them. All right, purchase goods for cash. Yep, purchases are always debited because the goods are coming in. So you're going to debit purchases account with 550. You didn't buy them on credit. You bought them for cash stroke bank. So in other words, you paid €550, that you, being the business, paid €550 to get these goods. Sales. Sales is always credited because you are giving goods. You're giving 1,230. So you're giving 1,230 worth of goods, but you're receiving the money immediately, bank stroke cash. So you are both, you being the business, you're giving goods and you're receiving money. Now these two are slightly different. Just remember, your purchases account, is always debited. So therefore, if you've purchases returns, that has to be on the opposite side. It has to be credited. Why? Because it's the opposite of purchases. Or to make this even clearer, purchases returns. Purchases are goods you bought. If you return them, well, then they're going out. Out means credit. So your purchases returns, just put P returns there. Your purchases returns is going to be credited with 540 because the goods are going out of the business, back to the people that you bought them from. You bought these goods on credit from creditors. So it's into creditors, out of the business, goods, purchases, returns. And again, the same corollary exists with sales. Sales account is credited. Yeah. So sales returns account has to be debited. It'll be the opposite of the sales. And why will sales returns be debited? Because goods, sales returns, goods that you sold are being returned back into us or me being the business. So the business is receiving back goods of 970 from these people that we sold goods to, and these were called debtors. Okay, so you will come across sales returns and purchase returns quite regularly. All right, so that's it. We're going to go on to a revision of those principles and the application thereon, still on double entry in the next lesson.
If you like this video, you'll love our notes. You can get some for free in the link in the description of this video.